Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world for you. Today we're diving into Heritage Commerce Corp's latest filing. I know, SEC filings can sound about as exciting as watching paint dry, but trust me, there's a story in here about growth, challenges, and maybe even a little bit of behind the scenes drama. This year, Heritage Commerce celebrated its 30th anniversary, which is a big deal for any bank, especially these days. But amidst the celebrations, they've also been navigating a tricky economic environment. We're going to break down how they've managed to keep growing, where they're investing, and what challenges they might face in the future. Let's start with the letter to shareholders. It paints a picture of solid progress despite a challenging economic landscape. The key takeaway, they saw deposit balances grow by 10% year over year. That's a significant increase, indicating they're attracting and retaining customers. Loan growth was steady at 4%, which shows they're still lending money and supporting businesses in their community. However, net income came in at $40.5 million, which translates to about 0.666 per share. While still profitable, that's a drop compared to the previous year's $64.4 million or $1 saved per share. That's almost a 40% drop. The letter attributes this to relatively elevated costs of funds. Basically, it cost them more to borrow money. Now, let's head to some of the strategic highlights. Total assets grew 9% to $5.6 billion. This is good growth, showing that their overall financial picture is expanding. But remember, net income is down. So it seems like costs are rising faster than their asset base. Their net interest margin, which is the difference between what they earn on loans and what they pay on deposits, declined to 3.28%. This directly reflects the higher rate environment. Banks make money on that difference, so a shrinking margin means less profit per dollar. The good news is credit quality remains strong. Non-performing loans totaled only $7.7 million, which is a tiny fraction of their total assets. They're also maintaining a healthy allowance for credit losses, indicating they're prepared for any potential loan defaults. The letter also highlights key investments in people. They've brought in new leaders to head operations, legal, and human resources. This is interesting as it suggests they're focusing on internal improvements to become more efficient and attract top talent. Succession plans are important, and bringing fresh blood may also be a strategy to shake things up. Let's move on to the proposals shareholders will be voting on at the annual meeting. One key proposal is an amendment to their bylaws to increase the range of the permitted number of directors. This seems like a fairly standard corporate governance move, giving them more flexibility to add experienced people to the board. It suggests the company is expecting further changes and they want to ensure smooth transitions. Now, let's get into executive compensation. This is always a hot topic. The company's pay for performance philosophy puts a heavy emphasis on variable or at-risk compensation, which means a good chunk of executives' pay is tied to how well the company performs. This theoretically aligns their interests with those of the shareholders. They're continuing with a long-term incentive equity program. 50% of executives' potential awards are in performance-based restricted stock units. These units vest based on the company's relative return on average tangible common equity compared to its peer group over 3 years. It encourages them to focus on long-term sustainable growth, not just short-term gains. Let's see how compensation compares to company performance. Deposits grew 10% and loans 4%, indicating strong customer relationships. Net interest income, however, decreased by 11% to $163.06. This is a core measure of a bank's profitability from its lending activities. A decline here suggests increased expenses ate into lending revenues. Their efficiency ratio is 65.88%. It measures operating expenses as a percentage of revenue. In general, a lower number is better, suggesting they're managing their costs or catching up. Diving into the executive compensation tables reveals some interesting details. We see Robertson Clay Jones, the president and CEO, had total compensation of around $1.7 million for 2024. Comparing that to previous years, we see that it's in line with the previous years. Around the 1.5 M mark, the company is giving stability in this area to the CEO. The summary compensation table shows that the board highly values the performance of the executives. The company has strategically integrated cybersecurity risk management. This is a must in a world that's all about digital business. The Corporate Governance and Nominating Committee is working on director recruitment, trying to get diverse, qualified people to help oversee the company in the future. This suggests ongoing succession planning. It is a very good sign to see the company has good plans to develop board and senior management for the near and long-term future. Let's talk about stock ownership. The company likes the leaders to have skin in the game, meaning that The company want to assure that the executive team's interests are aligned with those of the shareholders. Alright, looking at the financials, Heritage Commerce seems to be in a decent but not great position. They're growing, but their costs are rising faster, squeezing profits. The leadership team seems capable and they're making strategic investments in technology and talent. However, bank need to carefully manage expenses to improve its bottom line. The upcoming year will be critical for showing whether these investments will pay off. That said, it is concerning to see that net income is down almost 40%. But overall, it is not looking terrible. They are prepared to grow further. And that's your corporate decode for today. If you found this helpful, give us a like, subscribe, and let us know what company you want us to take a look at next. See you in the next video.